Hello and welcome to my take on your Daily 5 for the 16th of October. My name is Julius de Kempenaer and it is my turn to host today's show. In case we haven't met yet, I'm a senior analyst here at StockCharts.com and the creator of relative rotation graphs, or RRGs as they are commonly referred to. You can find my contributions in the RRG blog on the site. If you would like to be kept in the loop on everything that has to do with sector rotation and relative strength, please subscribe through the link below each article. Every Tuesday, I host a Sector Spotlight show from 10:30 to 11 a.m. Eastern. Again, if anything related to sector rotation and relative strength has your interest, please tune in or watch the replays on the StockCharts YouTube channel. I do enjoy the interaction with viewers and readers, so if you have anything to say, please do so in the comments section below each article and below each video. For now, let's start looking at some interesting charts. My starting point, as usual, is the RRG, and I have loaded up the relative rotation graph for US sectors here on the left-hand side. And from this picture, I am interested in the direction of the tails on XLP, the consumer staples sector, and XLC, the communication services sector, because they are moving in opposite directions. If we magnify that picture and isolate those two sectors and add a 26 weeks, so that's like 6 months, half a year tail, then we can see a very big rotation on staples, starting to head in the proper direction towards the leading quadrant. And what I'm especially interested in is the acceleration of the tail here. We call that the velocity. And the opposite rotation that's visible in XLC, communication services. If we quickly move to the charts for both of these sectors, then we see XLC still in a relatively good trend on a price chart, but on a relative basis, it's rolling over and it seems to be going back into that old range, which is basically pulling both RRG lines down. If we compare that with the chart on the staples sector, we see a similar move in terms of price, but we see the opposite move in relative strength. Here, staples has been testing the lower boundary of that range versus SPY for the last few weeks, and it's now actually starting to pull both RRG lines up. So the combination of the tails on RRG and those two charts suggests that we should start to move out of communication services into consumer staples. If we drill down further into the members, in this case of the communication services sector, then there are a few charts that are interesting in my opinion. Well, there's a lot of charts that are interesting, but the ones that I want to pick out for this session with on your daily 5 are Facebook, which is in the weakening quadrant and heading further down there. It's Twitter, which is inside the leading quadrant and pushing up there, and Dish, which is almost in a straight line heading lower. And here also I have actually zoomed in on those three tails, and I want to look at those three charts for those stocks. Let's start with Dish. I also talked about Dish in Sector Spotlight last Tuesday because it's now a position in the long short basket, and the reason for that is because the relative strength line is really weak. It is rolling over in terms of RRG lines, but it's actually confirmed by a completed pretty big double top, which is now starting to push prices lower, which fits in with a long-term picture of lower highs and lower lows, major lower highs and lower lows. So a price target for Dish is probably actually somewhere around that 17.5 mark. Now, if we move to Facebook, that is also not a very strong tail. The chart of Facebook in price terms looks a lot better than Dish, but if you look at what's happening in relative strength, it's getting a little bit tired, and that is translated into RRG lines that are actually rolling over and pushing Facebook into the weakening quadrant. That is standalone. If we look standalone at Twitter, then we see somehow like an opposite picture. Twitter is pushing against all-time highs. So in that respect, it's already better than Facebook, which didn't reach its all-time highs in the last rally. Twitter is doing that. But more importantly, it is breaking out of almost a year worth of trading range in relative strength, and that's now pushing those RRG lines above 100 and into the leading quadrant. And when I see this type of rotation on the RRG, so Twitter with a long tail moving to the right and Facebook, not really nosediving, but in relative strength terms, pushing into the weakening quadrant at a negative heading, I'm tempted to look at the ratio between the two. And that's the chart that I have here. So here is Twitter against Facebook. And as you can see, almost throughout 2019 and also the better part of 2020, it would have been better to own Facebook over Twitter. But that now seems to be changing. We see that a new potentially series of higher highs and higher lows is emerging. And with those tails on the RRG, I think it would be a good idea to actually, for the holdings that you want to have in XLCs, if you still want to have some holdings in XLC, or as a pair trade, to prefer Twitter over Facebook, which could be an interesting trade just to have something in communications, which as a sector is starting to deteriorate. Now, if we move then to the consumer staples sector, there are actually a few stocks that are worth looking at from the long side. And I have isolated those here on this RRG, which zooms in, and the two stocks are actually Cost and ADM, Archer Daniels and Costco. If we start with Costco, you see a very strong chart in terms of trend, a big consolidation triangle that was executed a few months ago, and we're still working our way higher. The relative strength is just starting to pick up. It's coming out of this bottom consolidation formation and getting more interesting. And that is translated into RRG lines that are pushing above 100 and actually pushing cost back into leading after a rotation through weakening, which is usually a pretty good sign. So cost is worth looking at from the long side. And then finally, we have Archer Daniels, which is actually this week and last week pushing to new all-time highs, which is obviously a very strong sign. And I like the combination with the breakout of the downtrend in relative strength. And clearly the RRG lines are now back above 100. So cost and ADM potentially interesting from the long side. Ladies and gentlemen, this concludes your Daily 5 for this week. For today, I have to say. Thank you for watching. I hope you enjoyed the presentation. If you did, I hope you know the drill. For now, please stay safe and be careful with your investments. And I'm looking forward to seeing you soon on the other side of the screen anytime soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.